Hello students, this is Vishal Jain, your faculty for ACCFR and SBR paper. Guys, today I am here to discuss with you the key mistakes which you can make in the group accounting chapter. Okay, this video will be equally applicable for FR and SBR students. Okay, now I have identified these mistakes from my analysis of the past 12 examiner reports, past papers, practice papers, mock papers, okay, the test which I conduct in my classes, the common mistakes made by my students in the classes, okay, and my experience as well. Okay, these are the common and the silly mistakes which you can do in the exam and which you won't even realize that you have made a mistake. Okay, so I will request all of you to watch this video till the end. Okay, and definitely like this video so that this video reaches all the ACCA students, and subscribe to my channel if you are new to this channel. Okay, so let us start this discussion on the key mistakes which you can make in the group accounting chapter. Point number one. Now understand, you know that NCI can be initially measured at either fair value method or proportionate share method. And how does it impact? So basically, if NCI is at fair value method, any goodwill impairment is allocated to group RE and NCI in the ratio of their holding. And if NCI is at proportionate share method, the goodwill impairment loss has to be recognized to group RE only. Okay, now generally the question gives you whether the NCI is at proportionate share method or fair value method. Now if the question is silent, then definitely you have to use goodwill NCI at proportionate share method. But if the question is using the terms called as full goodwill method or partial goodwill method, now what is the meaning of it? So understand, if the question says full goodwill method, it means NCI is at fair value method. F for full goodwill, F for fair value. Now if the question says that goodwill is partial goodwill, now it means that NCI is at proportionate share method. P for partial, P for proportionate share. I believe now this you won't forget. Okay, so understand, if goodwill is full goodwill, any impairment loss of goodwill will be allocated to group RE and NCI in the ratio of holding. If goodwill is partial goodwill, then you will allocate the goodwill impairment only to group RE. Second point, NCI. Now understand, if the NCI is at fair value, meaning thereby full goodwill method. Now generally the question gives you the fair value of NCI, but if at all the question is not giving you the fair value of NCI, then in that case you have to calculate the fair value of NCI. And how do you calculate it? So you calculate the fair value of NCI as number of shares held by NCI, multiplied by number of shares held by NCI multiplied by market price per share of subsidiary company. Now what I've seen, the students are making mistake that first point, they are calculating it by market price per share of parent company, which is wrong. They are multiplying the number of shares, total number of shares subsidiary company, wrong. They are taking the number of shares held by parent company, which is wrong. So you have to take number of shares held by NCI multiplied by market price per share of subsidiary. The question might give you the market price per share of both parent and subsidiary. So you have to be careful that you are taking the market price per share of subsidiary, not parent. Okay. Now, and when you are calculating fair value of share exchange, okay, as part of purchase consideration, then you have to take market price per share of parent company, not subsidiary company. So this is the second mistake which you can do in the exam. Now coming to third one. So all of us know that whenever on date of acquisition, we acquire the net assets of subsidiary company at its fair value on date of acquisition. Okay, and this fair value adjustment impacts goodwill. Okay, this is very much clear to all of us. But now I want to make it clear one more point. Any fair value adjustment post acquisition, any fair value adjustment of net assets of subsidiary post acquisition is as per respective standards, might be IFRS 9 or IAS 16, 38, 40. Okay, now it is not as per IFRS 3, it is as per the respective standards. It will not impact goodwill, it will be as per respective standards. Might be that fair value adjustment you can recognize in P&L or OCI, but it won't impact goodwill. Okay, now any fair value adjustment of parent either on date of acquisition or beyond date of acquisition, okay, when in any given time, will never impact goodwill. It will always be accounted for in line with the respective standards. So understand only one date. Fair value of net assets of subsidiary on date of acquisition. Any fair value adjustment impacts goodwill. Rest all is dealt in line with the respective standards. Now, fourth point, and this is the most important point. I have seen almost 95% students making a mistake here. Understand, guys, fair value adjustment of inventory and unrealized profit of inventory, both are two different things. Okay, both are two different things. Let me explain it to you. Fair value adjustment of inventory is done on date of acquisition. Okay, so what we do, whatever is the fair value adjustment on inventory, we add on date of acquisition. We add on the date of acquisition. Now, in the post period, if the inventory gets sold, then we reverse this fair value adjustment to the extent inventory got sold. Now comes the question, why? So understand the logic also. Though I have explained the logic in depth in my marathon session, okay? But still I'm explaining it here as well. Let's suppose the cost of an inventory is 100. Okay, in the SFS of subsidiary company, in the individual FS of subsidiary company, let's suppose the cost of inventory is 100 and subsidiary sold this inventory for 150. So what is the profit which subsidiary will recognize? 50 in the individual FS. Now, when the parent company acquired subsidiary company, definitely on date of acquisition, we will do the fair value adjustment of inventory. So now the cost was 100. But we did the fair value adjustment. And the fair value was 120. So definitely now inventory is valued at 120. But now if we sell the inventory at 150, what is the profit we should ideally recognize? 30, because 150 minus 120 is 30. But what is the profit which we have recognized in the SFS of subsidiary? 50. So that's the reason we have to reverse this 20. So understand, whenever we are doing fair value adjustment of inventory in the post period, to the extent inventory got sold, we reverse the fair value adjustment. But what is unrealized profit? Unrealized profit is the profit recognized by either of the companies but not realized by the group, meaning thereby the profit earned but not realized, meaning thereby profit earned on inventory remaining unsold. So unrealized profit is on the unsold goods and fair value adjustment in the post period is on sold inventory. So there is a difference between these two. So please understand this difference, and I have seen students making this mistake many times. Okay. Now, fifth point, loan issued as part of purchase consideration and intra-group loans, both are different. Why? Understand, whenever you issue the loan as part of purchase consideration, you are issuing these loans to the shareholders of subsidiary company. Okay, to the shareholders of subsidiary company. So it is not intra-group loan. Okay, so definitely parent will continue to recognize these loans in the group FS as well. But if it is intra-group loan, then parent company has recognized loan and subsidiary company has also recognized loan. This will get knocked off. Okay, so intra-group loan is different, and loans issued as part of purchase consideration is different. So please understand the difference clearly. Okay, now issue costs on acquisition. Okay, issue costs on acquisition. Whenever you are acquiring a subsidiary and you are incurring any acquisition costs or issue costs, all of that will go to P and L. Now, when you are calculating unrealized profit, the question sometimes says markup. The question sometimes says margin. What is the difference between these two? Markup is on cost. Margin is on sales. Now, the unsold goods inventory, the value which is given is the sales price. So now, whenever you have to do the markup, whenever the question gives you markup, so what you have to do? Okay, so calculate profit. If sale price is 500, markup is 25%. So what is to be 500 to 25 by 125? Okay, the logic. Understand the logic. Let's suppose cost is 100. So what is the markup? What is the markup? 25%. So 25. Now what is the sales price? 125. What 125? Right now we have to identify if the sale price is 500. What is the profit? What is the profit? So what we will do is 500 is the sale price. Okay. Now we have to calculate the markup, that is 25 out of a profit of out of a sale price of 125. So that's why we are doing 25 by 125. If this is margin, if this is margin of 25, then what we will do? Sale price is 500, margin is 25 out of a sale price of 100, out of a sale price of 100. So this is the difference. So markup, whenever it says, so you have to do it this way. And when it says margin, you have to do it this way. Okay, so please understand it clearly, guys. Markup and margin is different. Many students don't understand and realize the difference between markup and margin. So please understand the difference. Okay, markup and margin are two different things. Markup is on cost and margin is on selling price. Okay, now the unrealized profit which you calculate is on the selling price. Okay, why? Because see, understand, let's suppose P sold the goods to S and S is in the inventory. So who has earned the profit? P. Now whatever is the value of goods held in the inventory of S is the selling price for P, and we have to calculate the profit for P. So for P it is a selling price and we have to multiply the markup percentage of P and calculate the unrealized profit. Okay, so please keep this in mind. Now the next. So we have discussed 1 to 8, 1 done, 2 done, 3 done, 4 done, 5 done, 6 done, 7 done. Now 8. Group SOFP, understand, I have seen students making this mistake. So understand, irrespective of whatever is the percentage of ownership, be it 60%, 70%, 80%, 90% or 100% or whatever is the percentage, okay? If there is a control, I will add all the assets and liabilities of subsidiary company while preparing SOFP. Okay, while preparing SOFP. If it is my subsidiary, then I will add 100% of the assets, 100% of the liabilities of subsidiary. Do not say that, okay, I have an interest of 80% in the subsidiary, so I will take 80% of the assets of subsidiary. No. When preparing SOFP, you will take 100% of the assets, 100% of the liabilities of subsidiary company. Now, group SOFP. Do not forget, I have seen students, let's suppose, this is the most commonly made mistake that happens in the exam. Let's suppose this is the date of acquisition and you have given deferred consideration to the investee. Okay, you have given deferred consideration to the shareholders from whom you purchase the shares. Now, when you give deferred consideration, definitely you recognize it at its present value, and you know whenever there is a present value, there comes a concept of unwinding of deferred consideration, that is finance costs. Okay, and now you are preparing group SOFP here. Do not forget to recognize the finance costs. Now, what is the entry for this finance cost? So you have to reduce group RE, and you have to increase deferred consideration. That is a financial liability. And now see whether deferred consideration will be current or non-current. If it is to be paid beyond 12 months, non-current. If it has to be paid within 12 months, it is a current. So just check the classification as well. Do not forget to check the classification and the finance cost. Okay, finance cost on the unwinding of deferred consideration has to be recognized in the group retained earnings. Further, similarly, if there is a contingent consideration, there will be fair value change of the contingent consideration. So recognize the fair value of contingent consideration. Okay, now it will reduce or increase group RE, or it will increase or reduce the contingent consideration. Okay, again check the classification whether it is current or non-current, similar to what you did in the deferred consideration. Just that in deferred consideration it was the finance cost on unwinding that, but in a contingent consideration it is fair value changes. Also for SBR, one specific point, if the contingent consideration is in the nature of equity, do not remeasure it. Only for SBR students, if the contingent consideration is in the nature of equity, do not remeasure it. Mid-year acquisitions. if you are acquiring a subsidiary in the mid of the year and you have done fair value adjustment on the date of acquisition, do not forget to time proportion the excess depreciation that you charge in the post period. Okay, do it time proportionate. Okay, do it time proportionate. Time adjustment is required. Okay, now be careful while eliminating the finance cost and finance income. So there is a question Pandar company in your Kaplan kit where it says that subsidiary is acquired in the mid of the year. Okay, on the same date you have given a loan, the parent has given a loan to the subsidiary company. What is the console finance cost? Guys, I have discussed this question in depth in the second class of my marathon session for FR. Okay, so please go and watch that video for complete clarity. I will show exactly where it is. Just a minute. See, this is the question. The last question of that day. Okay, the last question. So you will find that video in the live section of my YouTube channel. FR top 15 important questions. Okay, FR top 15 important questions. The last question of that is this one, and I will strongly recommend all of you to watch this video if you have not done that. Whether you are an FR student or an SBR student, this video is a must for all of you because it will give you a complete clarity over few of the small concepts where you can make mistakes. Now, further, group P&L. So understand, when you are preparing P&L, group P&L, you have to do the time proportionate for each of the P&L items. Okay, let's suppose you have acquired subsidiary in mid of the year. Then you have to time proportionate revenue, cost of sales, distribution expense, admin expense, finance cost, investment income, everything. You have to do the time proportionate investment, tax costs. Okay, revaluation gain, whatever it is. Okay, so you have to do the time proportionate for each and everything unless and until it is specifically mentioned that this item is fully pre or fully post. Okay, so then if it is specifically mentioned that this item is fully pre or fully post, then first of all remove that item, do the time proportionate, and then accordingly adjust that item. Okay, so this concept also will get covered in that Pandar company. Okay, question. Okay, so please watch that. That's a wonderful question, I will say. Now, one more mistake which the examining team is strongly putting here. Examining team is saying most of the students have forgotten to split. Specifically, this is for SBR students. FR students. Specifically, this is for FR students. Most of the students have missed to show the split of profit for the year and total comprehensive income split between profit that is allocable to the owners of the company and NCI. Profit that is allocable for owners of the company and for NCI. So you have to show the split for profit after tax and total comprehensive income. Okay, so you have to show the split for both of them. And 95% times even I have noticed that students are not giving this one. So please you have to give this one. Now, understand, let's suppose you have acquired a subsidiary 80%. Now, when you are preparing group P&L, will you do this 80% adjustment for all the P&L items? No, as I said, for SOFP also, were we doing 80% adjustment? No, we were taking all the assets. Similarly, here we'll take all the P&L items. But yes, we will do time adjustment, but we will not do percentage adjustment. Time adjustment we will do, but we will not do percentage adjustment. Now, group P&L, while allocating the profit to parent and NCI, do not just proportionately allocate, rather calculate the profit attributable to NCI and the rest is for parent. Now, what happens here? Many times I've seen this happening. So, while allocating, so understand, when you are preparing group P&L, okay, what generally student does is they calculate profit after tax. If there is any other comprehensive income, they add that and they write total comprehensive income. This is what 90% student does. They forget to show the allocation of the profit to parent and NCI. Now, for the students who are showing the allocation also, what they are doing, let's suppose total comprehensive income came to 100. Okay, let's suppose came to 200. came to 200 and NCI percentage is 20%. So what they'll do is 2% to 20% of 200, that is 40, is for NCI, and 200 ka 80% is 160 is for parent. This is wrong. So what you have to do, you have to take the profits of subsidiary, do the time adjustment, whatever adjustments that you have done in the console P&L which impacts the profit of subsidiary, adjust that, calculate the adjusted profits, then multiply the NCI percentage. Okay, and this is the profit which gets allocated to NCI. All the remaining profit is for the parent. So do not forget to calculate it this way. Okay, do not forget to calculate it this way. Now, reduce only parent's share of dividend from subsidiary from investment income. Okay, now understand what I have noticed is, again I'll tell you, this is again a very important point. Let's suppose subsidiary, this is parent, this is subsidiary. Subsidiary has given a dividend, let's suppose, of 10 million and parent is holding 80%. Tell me, what is the dividend which parent would have got? 8 million. 2 million would have been received by NCI. Now what a student does while preparing group P&L, from the investment income he reduces 10 million. So please keep in mind, parent has received 8 million. Parent would have recognized 8 million as in the investment income or dividend income. Okay, so you have to eliminate 8 million from the parent's investment income. Okay, in the group P&L. So you have to eliminate 8 million and not 10 million and not 10 million. Please keep this in mind. Now, this is again a wonderful silly mistake. What happens most importantly in FR, actually I can tell you, FR and SBR both of the students does this mistake. Whenever the question asks you to calculate the gain or loss on disposal, now what we do? Oh, gain or loss on disposal, recognize sale proceeds, de-recognize NCI, de-recognize net assets, de-recognize goodwill, whatever is the difference is the gain or loss on disposal. No, my dear friend, apply some logic. Read the question properly. Many a times question is asking, calculate the gain or loss on disposal in the individual FS of parent. Now, what will you do in individual FS of parent? Sale proceeds minus cost. Simple. Sale proceeds minus cost. Simple. You are not required to do this much of analysis, which you did. So please read the question, whether the question is asking you to calculate gain or loss on disposal in the individual FS or the group FS. If it is individual FS, then sale price minus cost or sale price minus carrying amount on date of sale. Okay. But if it is asking in the group FS, then I will apply this formula that recognize sale proceeds, de-recognize NCI, net assets, goodwill. Okay, the difference is called as gain or loss on disposal in the console P&L. So read the question carefully, whether the question is asking you to calculate the gain or loss in the console P&L or the individual P&L. Okay, please read the question carefully. Okay, now when the question asks you to calculate the gain or loss on disposal in the console P&L, now be very careful. Sale proceeds you have to compare with the value of NCI, net assets and goodwill on the date of disposal. What is the value of these three? Net assets, NCI and goodwill on the date of disposal. What is the value of all these three? And then you have to find out the gain or loss on disposal. Okay, now associates. So I have discussed 18 and 19 as well with you. Associates. Now what is happening with associates? Unrealized profit. Understand, guys. So unrealized profit can be from parent to associate or associate to parent. Now understand, if it is parent to associate, who has earned the profit? Parent. So you will reduce parent's group RE. Okay, you will reduce parent's group RE. Right? Now who has the inventory? Associate. Are we recognizing in the inventory of associate? No. So what we have to do? We have to reduce the inventory investment in associate. If you are preparing group SOFP, then you will reduce group RE and you will reduce investment in associate. But if the question is asking you to prepare group P&L, then you will add this to cost of sales. Why add to cost of sales? Add to cost of sales means increase cost. Increase cost means reduce profit. That's what we are doing here. Reduce profit, right? Unrealized profit means what? Reduce profit. Okay, now again, if it is associate to parent, who has earned the profit? Associate. So where is the associate's profit going? Share of profit. So reduce share of profit, reduce share of profit. Now who has the inventory? Who has the inventory? Parent company. So reduce inventory. So if the question is asking you to prepare group SOFP, again reduce group RE, because the share of profit ultimately goes to group RE only. Okay, so reduce group RE and reduce inventory, because the parent company has the inventory now. Okay, now if the question is asking you group P&L, then reduce from share of profit of associate. Okay, now one more point that you need to take care: when you are calculating unrealized profit, what do we say? Unsold goods multiplied by profit percentage of seller company, whether P, A or S, whatever it is, parent, associate or subsidiary, whatever it is. Okay, but understand, this is what you will do for calculating the unrealized profit in the case of subsidiary. But if it is the case of associate, you have to also multiply associate percentage. Do not forget that. Okay, you have to also multiply associates percentage. Do not forget that. That's what I have written in point number 22. Unrealized profit is profit on unsold goods multiplied by associate ka holding percentage. Okay, now for impairment loss on associate, now what student does is, sir, everything we are multiplying by associate ka share percentage, then impairment loss also we need to multiply by associate ka share percentage. No, my dear bacha, no. Understand bacha, yahan pe what you have to do here is, this impairment loss is for your investment only, so it is your share only. Again, don't multiply the share. It is your share only. Okay, so impairment loss on associate, impairment loss on investment in associate, do not multiply associate ka percentage. Okay, for associates, see, understand, for subsidiary we knock off trade receivables, trade payables, loan receivables, loan payables. Okay, we knock it off. But for associates, we do not do the knock off of the contra with associates. Okay, we do not do the knock off of contra with the associates. Now one more concept. Though this concept has never been tested, but you never know when this concept can be tested. Okay, now understand, associates, you know what is the treatment that we do with the associates? We recognize investment in associate. We recognize investment in associate at equity method. Okay, now understand here, when you are recognizing the investment associate at equity method, okay, on the date of acquisition, okay, you recognize it at cost, and also you calculate goodwill. You are not recognizing goodwill anywhere, but you calculate goodwill and just disclose it for your disclosure purposes. But what if gain on bargain purchase comes for associate? Then what if gain on bargain purchase comes for associate? Then in that case, you have to recognize this gain on bargain purchase. And what is the entry for that? The entry will be investment in associate account debit to gain on bargain purchase. This will be recognized in other income. So basically, let me take up an example of it. Okay, now example, cost of investment is 100,000. Okay, share of net assets of associate is, let's suppose, 80,000. So what happens? 20,000 is goodwill. So will you separately show it off goodwill? No, you will just show investment at 100,000. Simple. But if, let's suppose, this is not 80,000, rather it is 110,000, then what will you do? Then you will say that your gain on bargain purchase is 10,000. Then what will you do? So then your cost of investment will be 100,000. Then you will add gain on bargain purchase 10,000. You will add gain on bargain purchase 10,000, and then you will apply equity method. This gain on bargain purchase you will recognize in P and L as other income in the group P and L. In the group P and L. Okay. One more thing. Okay. Now, investments. In treatment of investment in SFS of parent company. In SFS of parent company, this can come as a theory question. For group accounts. Okay, investment in SFS of parent company. Okay, so I have told that ideally investment means investment in equity instruments of another company. Okay, so it has to be as per IFRS 9. It can be recognized at fair value, that is at fair value through P&L, which is a default classification, or it can be recognized at fair value through other comprehensive income, which is an irrevocable option available only at the time of initial recognition. But IAS 27 gives you an option to measure it at cost, and generally we have seen that the investments are recognized at its cost only. Investment in subsidiary, associate and joint venture can be recognized at its cost. Now, standard gives you one more thing. Okay, this point is only for SBR students. Understand, guys? So what it says, if standard says that if the group has no subsidiary, and the group only has investment in associates or joint ventures, and the group does not prepare console FS, then it says in that case investment in associates and joint ventures can be recognized at equity method in SFS of parent company as well. So these are the common mistakes of group accounting, which I don't want you to repeat that in the exam. Okay, now if you have any other mistakes which you do in the exam, so please write down in the comment box. I will try to make a video on that as well. Okay, so if you do any other mistakes in the group, please write in the comment box. That's all for the day, guys. I hope this video helped you, all of you. Okay, that's all for the day. Bye bye.